Matt Thompson. He's the managing partner of Thompson Capital Management. And his presentation is starting right now. Just a word about Thompson Capital Management. So his US Smart Index has, since inception in November 2016, posted roughly double the return of the S&P 500 with less volatility and negative down capture. I think this is something a lot of people are interested in. So please, Matt, over to you.
Thank you. Thanks everyone for joining us. Last but not least, so I'll try to make this short and sweet. So I'll just jump through the disclosures here. Past performance is not indicative of future returns. You can find more information on the SEC website about Thompson Capital. So Thompson Capital was founded by my brother Mike and I. Our last name is Thompson, so very unique name here. We founded our firm in 2019 with really built from a book of business that we had built from 2011. And we're close to 200 million in AUM today. We are a specialist asset manager. So we're an investment advisor, but we're a specialist in that we manage portfolios for particular portions of people's overall exposure. So risk responsive investing is our tagline. So that just means that we change our exposure to the market based on the message that we're getting about risk aversion in the marketplace. We run, I'll talk about two main strategies today, Smart Index, as Matthias mentioned, and our second one is Alpha Seeker. And both of those we run in managed accounts. And also we are a sub-advisor to the Little Harbor Market States Alpha Seeker ETF. That ticker is MSVX. And you can go to lhafunds.com for more information on that product. So here's our quickly on our backgrounds. My brother and I obviously have known each other for a little while and have worked together for the better part of 15 years here. Our career spans the last 20 years. Mike's a little bit older than I am, a little wiser, but he started in 1996. And I followed him shortly after. You know, our background was in the traditional buy side, equity, fundamental research. We both have our CFAs, which is, you know, fundamental type approach. And so we really learned portfolio management and, you know, the fundamental aspects of the business early on. And over the course of our careers, we've gradually moved from these big firms down to, you know, today our independent firm. And the fulcrum really over our last 20 years was at a family office that we worked for in 2008. We went there in 2008, and that during that period is when we came up with the system that we use today, which is called our volatility dashboard. And that's just a quantitative system that sort of looks at the volatility marketplace to get a read on risk aversion in the marketplace to help us make decisions. So really, we've been in business for 20 years. We've seen three major crisis periods, and a classic training of, you know, fundamental stock picking doesn't help very much in crisis periods. So we wanted something that was a better outcome than just buy and hold type investing. We wanted a more robust approach and process that didn't rely on any of our predictions, you know, or any crystal ball type investing. And then this year as well, we partnered with Little Harbor Advisors in Marblehead, Massachusetts, to be able to just deepen our bench and expand our reach and bring new products to market. So our background is varied. We were in big firms, small firms. We've done professional proprietary trading. We worked at family offices, really seen all parts of the business. And the system that we developed then is on this page here. Let me bump it forward. So what we do at Thompson Capital in both our portfolios is we listen to the message from the VIX marketplace. So the VIX index has been around since the 80s, and it does some math on option prices to come up with one number that represents risk aversion in the market or demand for hedging in the market. And in 2004, kind of right in the middle of our careers, the VIX index is not tradable. The VIX products that are tradable started in 2004, and we got to watch that market grow right here in Chicago got to watch that market grow into the world's premier marketplace for hedging. So our approach at Thompson Capital is, let's not make our own predictions. Let's just watch what people do in the hedging marketplace. So there are institutions and investors all around the world that use VIX products to express their views on volatility and risk aversion. So conceptually, what we're doing with the volatility dashboard is monitoring all the trading that's happening in that VIX marketplace. And we're just looking mainly for, and there's a lot of nuance under here, but we're looking mainly for the difference between near-term expectations for volatility, near-term prices, and medium-term prices in volatility. And the idea is that when you've got those near-term prices below the medium-term, that's a healthy market. That's normal markets where uncertainty increases with time, and that's generally when equities rise and do well. And then on the other side is a stress type of environment when the near-term prices for VIX products are higher than the medium-term. That just indicates that there's some sort of demand for hedging against something in the marketplace. So we don't even need to know what it is. We just need to watch that demand changing, and we respond accordingly. So what you're looking at on this page here kind of encapsulates that idea. The chart here, the black line is the S&P 500 index, and this is through the end of May. And then the green and the red is an example of what I just mentioned in that VIX marketplace, where the higher green you go, the more that near-term prices are below medium-term, a healthy market. So higher green is healthy market according to the VIX, and then on the opposite is these red periods, and we saw that in the Corona crisis in March, is when the near-term prices for volatility start to move above the medium-term to a sufficient degree. And you can see what happens, is very correlated with an S&P fall, is that stress signal from the VIX marketplace. And I've kind of marked off 3 lines here that I think kind of encapsulate the year so far. Is, in late January, according to the VIX through our dashboard, we monitor this on a real-time basis. You can see that stress, that kind of warning shot there. That was right around the time when China started to have some of their virus headlines come out and some of their shutdowns. Market kind of wobbled a little there. We saw the VIX get a little nervous, and then in February, for whatever reason, things got better again, at least on the stock side. And you can see that the VIX marketplace kind of regained some health, but not quite where it was. And then it really started rolling over, I think, as it started spreading out of China around that time. And that's when the hedging demand really kicked up in the VIX. And we get this stress signal from the marketplace. Our approach at Thompson Capital and our portfolios is that when we see those stress markers, pretty simple, we just decrease our market exposure. And we do that by moving our S&P exposures up and down, or adding volatility exposures in the portfolio that rise in price when VIX rises. And that's really, at the end of the day, what we're trying to do is avoid these major crisis periods. We're not trying to take out every little wiggle and waggle in the stock market. What we're trying to do is decrease our exposure, or even avoid completely crisis periods like we saw in March, when the S&P dropped almost 35% in just a couple weeks. So this is our philosophy at Thompson Capital in both of our portfolios. And here is how we've done on the year. This is through, it says May 30, but May 31st. Year to date, we're doing well in both our strategies. I'm showing you both Smart Index in the orange here, and then Alpha Seeker in the blue. So the main difference between those two strategies, both of them use the signal from the VIX marketplace to adjust portfolio exposure. In Smart Index, we own the S&P 500 at the index level at all times. So this one is tied, specifically to that beta of the S&P 500, and then it modulates exposure using VIX instruments. And Alpha Seeker is slightly different, where it doesn't own that S&P all the time. It does use S&P and VIX instruments, but it modulates beta just between kind of -1 and +1 idea on that signaling from the VIX. And so you can think of Smart Index as a kind of a core equity allocation, hedged equity, a risk managed equity. And then the Alpha Seeker strategy is more of an alt exposure, very low correlation, and it generally takes up a smaller portion of the portfolio. So here again are the 2 lines. Here's kind of that warning shot in January, and then the real deal, we're calling it here, when VIX really got nervous about the market. And so when we see that those stress signals, we're going to respond. And what we do is essentially go negative beta in Alpha Seeker, and you can see the lines start to pick up as the S&P falls. So that's negative beta. And then in Smart Index, we decrease our S&P exposure, still holding up to about 85% exposure in the S&P, and then additionally we will buy volatility exposures that go up and benefit when volatility rises, which is really the hallmark of a crisis. And so both strategies were able to perform real well during the actual crisis. Smart Index was up 19.5% in March alone, while the S&P was down, I think, 12. Alpha Seeker did about the same there in March. And then since then, we've had this nice strong rebound in the equity markets, and that stress has started to come in a little bit in the volatility space. I wouldn't say we are back to normal, but we've been moving that way in volatility. So we've been taking off our hedges, decreasing our hedges really since April and May in Smart Index. And Alpha Seeker is just sort of reflecting that nervousness in the VIX right now. So we've been able to profit, in that crisis period much more than avoid. We actually profited from volatility expanding exponentially like it did in March, and then since then, benefited from that equity bounce. And the nice part for advisors and investors is that we can capture the nice part of a bounce after a big crisis like we had in March, without having to, come back out of a big deep hole like regular index investments would. So we've been running both strategies for a number of years. Alpha Seeker since 2011 and Smart Index since 2016. Both have performed very well. As Matthias mentioned in the beginning, we've roughly doubled the S&P 500 return in Smart Index, and we haven't done it by taking more risk or levering up, good years. We've done it by outperforming on the downside. So I've put the up and down capture for this strategy on this slide, and we've gotten about 76% of the upside of the S&P 500. So matching, a little behind the S&P in good years and up periods. But the outperformance is really coming on the downside. We've got negative down capture since inception, which means that in total, Smart Index has made a little bit of money in all of the down periods for the S&P since 2016. And you can see here that the same thing with the drawdowns. We're about half. Smart Index is about half the drawdown of the unhedged S&P. And the volatility is actually a little lower. So again, we're outperforming by controlling risk well. And then Alpha Seeker, just on the bottom here quickly, we're ahead of the S&P since 2011 in this strategy on an annual basis. And really the key is the real low correlation of this strategy. Since we're not tied to the S&P here, we move our exposure to the market up and down based on what the VIX is telling us. And that has produced a nice uncorrelated return stream. And the whole goal is really just to help portfolios. So in either flavor here, including these strategies in a portfolio with stocks and bonds and your other alts, really improves the portfolio. So thanks for listening. I'm happy to take some questions. And be sure to go out to our website, Thompson Capital, is thompsoncm.com. And then Little Harbor Advisors, lhafunds.com, where you can find more information about MSVX.